I'm going to start so that next time around, when I say 11:25, I'm going to start at 11:25. If I have to speak to an empty hall, I think I know that it's not empty because lots of people watching on YouTube. Okay, so very quickly, let's do the 14th Finance Commission. It presented its report in December 2014. In the 15-16 budget, it was adopted. And, as you know that the Finance Commission's statutory body, every 5 years, it makes recommendations on, several things, but what is called, the vertical split and the horizontal split, i.e., how much of the total divisible pool should be shared between the center and the states. Until the 14th Finance Commission, it used to be 32% of the divisible pool, and then that was increased by a hefty 10 percentage points to 42. You have to keep in mind, of course, that what the Finance Commission basically was trying to say was that, okay, let me just give you, it's an interesting historical point which I think you'll like, is that over time, India has been fiscally decentralizing. More and more, every Finance Commission has said more to the states, and in a sense, that's what kind of federalism is about. Many more, we know that the rule of optimal public finance is basically that the central body should basically spend on public goods, or goods which have externalities across the country, whereas the state governments should spend on all the things that, education, health, that concern the state. So the allocation of spending essentially and taxation should be, the center only provides, what are common public goods to everyone, and the states do their own thing. So over time, what's been happening is that we've been decentralizing, but there was one episode where that trend towards decentralization was actually massively reversed. Can anyone identify what that reversal of an ongoing trend was? At one point in time, we started centralizing a lot rather than allowing the decentralization to continue. And that was when the centrally sponsored schemes started happening. Essentially, the center said, we are going to determine certain spending priorities, Sarv Shiksha Abhiyan, National Rural Health Mission, Jawaharlal Nehru urban stuff. So that was actually an aberration in the history of Indian fiscal decentralization. What the 14th Finance Commission essentially said was, no, we want to go back to the original trend. So we are going to give more of this to the states, but we also expect that centrally sponsored schemes will be rolled back, and therefore that trend of the center spending more and deciding state spending more, deciding their own priorities. So it was a package. So this is a bit misleading in terms of how much extra was going to the states, because there was also going to be an adjustment to that. Of course, what actually happened in principle was there was a first round of rejigging of the center-state allocation on the CSS, and then the Shivraj Singh Chauhan committee was set up, which finally came up with a kind of slightly different allocation than what was originally actually envisaged by the 14th Finance Commission. Now, I just want to show you what the implication of this is. It's really remarkable. This is a chart that shows if you combine total gross tax revenue of the center and the state's own tax revenue, what fraction of that is now going to the center and what fraction to the states. After the 12th Finance Commission, it was still about 47, 48 with the center, almost 50-50. After the 14th Finance Commission, it's basically 60-40. So in that sense, therefore, spending power has once again gone back more to the states as kind of originally, I think, envisaged. So that's the vertical part of it, how much sharing. Then there's the horizontal. The amount that is given to the states, the total amount, how will it be allocated between the states? And here, all I want to say is that the 14th Finance Commission formula for, what are the criteria, how they should be weighted, were actually very different from the 13th Finance Commission. In particular, I want to highlight the big difference in that bottom. So essentially, the 13th Finance Commission wanted to incentivize state performance. They said, you'll get more money, the more, and this fiscal deficit was how much own tax revenue you're generating was one component of that. The 14th Finance Commission said, it's not the business of the center to do this, incentivize. Their business is basically, kind of ensure horizontal equity, and that's what they basically did. So it was a very different philosophy that underpinned the 13th Finance Commission relative to the 14th Finance Commission. And in a sense, and then the 14th Finance Commission, what I was alluding to earlier, it allowed states, in response to this pressure from the states, we're running out of revenues, discoms are in bad shape. They allowed 3 criteria to relax their thing, but I think subject to a maximum of 3.5. They cannot exceed 3.5. Correct, Kapil? Yeah. So these are the criteria that would. So they also said something on local governments. We'll come to that when we do urbanization. And now let's move on to the goods and services tax. Remember, the Honourable Finance Minister was there yesterday. From our meeting, he was going to the GST, and I think it's truly a remarkable, revolutionary change that's going to come about. Of course, I was involved. I wrote a report on the revenue neutral rate, December 2015. That was the period when a lot of political action was going on around this. Between then and August of 2016, when the actual constitutional amendment bill was passed, I think there was a lot of discussion on revenue neutrality, what would be the structure of rates, etc., etc. It was truly one of the more exciting things I've been part of in government. And so I've learned a little bit about the GST, which I want to share with you. The outline, what is the GST, what are its benefits in India, especially in India, and something that makes it very topical. So I think that the GST could be, should be an eminently teachable subject in your classrooms in a way that's, I think, could make the thing come alive. I honestly, it's very exciting. It's a very interesting thing. So if I were to ask you what is a GST, first of all, in tax policy or in taxes, we have 2 broad divisions, right, between direct taxes and indirect taxes. Direct taxes are levied on basically income. Indirect taxes are levied on, either production or spending or, one of those things. And the GST is, the goods and services tax is basically a value-added tax levied across goods and services. And here's a small thing that you should keep in mind. It's a value-added tax, but actually it ends up as a tax on final consumption expenditure. So it's interesting. If it's a value-added tax, basically it seems like it's a production tax, but it's actually a consumption tax. And why is that? And this, remember, y is equal to c plus I plus g plus x minus m. What happens is, in this equation, most government expenditure is exempted from taxes. Exports are 0 rated and not taxed. Investment, you get input tax credits for investment. And so basically, and you do tax imports, which is part of final consumption expenditure. So basically, this value-added tax becomes a final consumption tax because exports are not taxed, imports are taxed as part of final consumption expenditure. If you buy capital goods, you get input tax credits, and so government expenditures mostly are exempt. And so this is the sense in which a value-added tax is actually a consumption tax. Okay, the GST in India, very, very interesting. It's going to be a dual tax. There's going to be the GST, there's going to be what's called the CGST, the central government, the SGST, state government, and the IGST, which is going to be the combined. It will be levied by both the center and the states and will replace all current domestic indirect taxes levied by the center. Now the center levies the excise tax and the service tax. The states levy the VAT, and so. But here is the point at which I'd like to respond to the question that was raised on, because of this. Okay, let me come back to that in just a second. Let me come back to that. So essentially the excise, the CST are origin-based taxes which benefit producing states. The GST is a destination-based tax. So in a sense, what is going to happen conceptually is the net producing and exporting states in principle will suffer and the net consuming states will benefit. I say in principle very carefully, because in practice what we think, we've done some calculations, there may not be that much disruption as people think, but we'll come to what will happen if there is disruption. So this is the GST in India. All countries around the world since about 1980 have been adopting this. Now you see this has not even been updated. I think about 130, 140 countries. In fact, don't look at ignore the numbers in this. Look at the blue. These are the only countries left that don't have a value-added tax, and the United States is one of them. I think Burma is another. I think this chart is wrong, because you know that big blotch of blue that you see there? Do you know what country that is? Which country is it?
Denmark.
Yeah, Denmark. Yeah. So I'm surprised it's there, because I think Denmark does have a VAT. So I think we should check that. Again, one more thing, minus marks. You can give us minus marks for having incorrect information. So we'll fix this. Huh? We'll fix this. Okay, now I want to, this is one example I want to take you through, because you have to understand what a GST is and what it's not. So there's a lot of talk about it. What is this? So this is an example. You have to sit with me, and this is an example I would like you to teach all your students, because this is what makes them understand what a VAT is all about. So remember the GST, so think of it as a value added tax. So we have 3 columns, a full GST. In the second column, the GST where the final good is exempt, i.e. that is it's a zero rate, it's a rate on it, but it's not zero rated, it's exempt, and I'll tell you what the difference is. And the third example is when there's no VAT, when there's cascading. What is the difference between these 3, how it works in practice? So in the first row, we're just assuming that there are 3 stages, A, B, and C. Each stage, 100 rupees of value added happens. Simple. In the GST with full input tax credit, work through the example, 10% on value added, sale price 110, he pays a tax liability of 10, his input tax credit is 0 because he has no inputs, everything is value added. A sells to B at 110, B charges on the value added on his stage and the previous stage, because he's going to get the input tax credit. So 10% of 200, he pays a tax of 20, and therefore his sale price is 200 plus 20. Now he pays a tax liability of 20, and this is the key part. He gets an input tax credit of 10 for the tax that was part of the sale price to him, because he doesn't have to, he only has to pay input tax credit, and therefore he gives the government 20, gets back 10, so his net tax paid is 10. In the third column, same process. What you find, C pays the tax on the value added in the previous 3 stages, 300 times 10% is 30, 330, that's what the consumer is charged, and he pays similarly 30, and then he gets back the credit for the previous 2 stages, and so he pays 10. So the final price is 330, the tax is 30, so the tax rate is 10%, exactly as the headline number says, the tax rate is 10%. So you get value added of 100 plus 100 plus 100, 300, the tax paid is 30, and so it's a 10% tax. Now, when the good is exempt, what it means is that at the last stage, C does not pay any taxes. So in the GST, for example, a lot of kind of agricultural goods, for example, when they're sold finally, will face a zero charge. Same thing happens as in this, except that when it comes to C, he doesn't pay any taxes, right? So his tax is zero, so he charges 100, 100, 100, and the 20 of the taxes of the two previous stages. The consumer pays 320. The total tax rate now is 6.7%. 20 is the total tax paid, 300 is the value added. Now, I want you to keep this in mind. Even though at the final stage it was 0%, the actual tax is not 0% that the consumer pays. It's, you know, because there were taxes paid at previous stages, and it is. Now, what do we mean by cascading? In the old days, in the states before the VAT came in, there used to be kind of sales taxes at every stage. Here, I want you to see what happens here. 110, 110, same as before, he pays taxes. Now, B charges 110 because he is not going to get an input tax credit. His cost is going to be 110, 100 is his value added, 210, he pays 10% on that, 21, and so 210 plus 21 is 231, so he pays a tax of 21. By definition, there's no input tax credit, so his tax paid is 21. Same thing happens at the next stage. What happens is that at every stage, you end up paying taxes on the inputs on all previous stages and the taxes paid on all previous stages. And you see here, the total tax is 64.1 compared to the VAT, which was 30. So the effective tax rate is 21.4%. Now, I want this example, take your students through it carefully, because it has this kind of exemplifies what are the key features of a VAT. First, notice how taxes are paid at every stage. Because in principle, a VAT could be simulated, it happens, say, this is what happens in the United States. What you could simply do is to say, at the final stage, the value added is 300, so only C is charged. He's the final retailer. He sells 100, 100, 100 times 10, 330, it would be the same thing. So a VAT is equivalent to a tax only at the final retail stage. But this is the difference. In a final retail stage tax, only that final person pays taxes, because A and B will not pay any taxes. It's a final retail sales tax. And so the difference then between a VAT and an equivalent retail sales tax is you get taxes paid at every stage of the production process, whereas in a final retail, only one. And the reason we do it this way, there are two reasons we do it. One, if you get every tax from one person, if you miss out, you could easily miss out on a lot of retailers, you lose a lot of taxes. Here, everyone is in the tax net, so the chances of missing out are much less with a VAT. One, that's one. Second, yeah.
One small question.
Question, yeah.
Do you presume that demand elasticity is in,
Okay, so the question is, do you presume demand elasticity to be zero or infinite? Now, I didn't, so that's a good question. Let me tell you why it's a very good question. Is that here we are just assuming that the tax is passed on, right, to the final consumer. Now, I think that whenever you have discussions of this sort, you should perhaps precede it by saying there's a distinction between who pays the tax and what is the incidence of the tax. And that's going to depend upon demand and supply elasticities. And the rough rule of thumb, I don't want to go into this great detail because it's not a course on the Indian economy. You should teach this in a course on public finance. Essentially, that when you have a tax, that you have supply and demand, whoever is the more inelastic side of that ends up paying most of the taxes because the tax can be passed on easily. So that's a question about incidence. Here I'm just taking you through a mechanical example of how the tax works. Now, the second and absolutely fundamental and most important thing about the value-added tax is that it's self-policing. In order to get input tax credit, a dealer has to ask his seller for the invoice, forcing a paper trail. So essentially, the key thing here is that pays 20, this man pays 20, but unless he gets his input tax credit, he will have this tax liability, and so he has an incentive in order to get this, to go to the previous guy and say, give me your invoice saying, you paid a 10% tax. That is key to the GST, and the beauty is going to be in India is that when the system is up and running, 3 billion such invoices, what A said he paid to B and what B said he bought from A, that will be matched automatically by the computer, and so you'll get that kind of automatic matching which comes from the GST. As I told you, it avoids cascading, which is paying taxes at each stage on value added and taxes at all previous stages. Remember, cascading can be huge. The difference between a 21% tax and a 10% tax is what a GST gets rid of. And finally, and this is the point I wanted you to remember, that you think that for a food product, let's say, which under the GST 0%, that is not the actual tax, because a lot of taxes are embedded at previous stages for which you don't get input tax credit, and that will be passed on to the consumer. So the consumer ends up paying a de facto tax of 6.7%, even though the headline rate says 0%. So these are some key features of a VAT or a GST which you need to keep in mind. Taxes at multiple stages, not like a retail sales tax, many advantages. Self-policing the paper trail. There's a very nice paper by a professor called Dina Pomeranz, who actually does a study in Chile and shows what the impact of this self-policing is, how it increases greater compliance. You avoid cascading, and always when you think of the GST, especially when there's a zero rate, do not confuse the headline rate from what is the actual tax incidence. Question?
How self-policing will be possible if there is an intermediary product which is exempted?
Yeah, so very, very good question. Now, I'll give you that example here. Take your middle example, right? Supposing B stage was actually exempted, then it would break the paper trail, and you would get cascading, and therefore, so the difference between what we have today, which is like a GST in some ways, the excise tax, yes, you get some input tax crediting, VAT also you get some input tax crediting, but with the GST, and so there are breaks in the chain today, but for example in textiles, before the GST comes in, lots of breaks in the train, as you said. With the GST, that should become seamless, and the kind of problem that you've identified will not happen. That's why it's very important that all taxes be part of the GST net, so that the input tax credits can flow and the paper trail be created.
So the government should try that intermediary product should not be exempt.
Exactly. Yeah, absolutely. Question? Yeah.
Just quickly, so underreporting of value-added to escape tax still remains a problem in this, or?
See, then you have to collude. You can't underreport, because if the other guy says he sold you 10 and you say, so that there's again a built-in mechanism against it. I mean, it's still possible that you're outside the net altogether. That's still possible. Yeah, that's still possible. Yeah. Question?
What is the issue when there is a purchase from outside and where there is a backward supply chain in the same company? Because if a person is purchasing from outside, he will get the credit, but he is manufacturing from the same. So then what will happen on the trail? Same product. Input
So you're talking about intra-company transactions.
Themselves are manufacturing.
Captive.
Yeah. So the question is, what happens if you have a kind of vertically integrated company that is, doing this entire production chain? Kapil, you have a better answer than me?
It depends,
Take the mic.
suppose the company is in one balance sheet, the whole company is having only one account or one balance sheet, then if you are purchasing the raw material, from raw material you will get the input. Suppose the whole company has the different, suppose they are making tires also and they are making the car also. But the car account, or we can say that when they are making car and they are having the separate account for the car, although they are working under the same roof, but account for the car, tires are the different, then they will get the input tax credit. Because there are two different entities, they are working under the same roof. If they are having one account, then they will get input tax credit from the raw material from where they have purchased it. Right?
Yeah.
I hope it makes
Yeah. Now,
Question was different. One question.
yeah, I want to move ahead unless, because we have to finish this. Yeah, quickly.
The second case where, continuing from what he asked, is that if there is an intermediary which is exempt, then as you say, that all intermediaries have to be identified, but the same product can be a product of final consumption as well as an intermediate product. How will you resolve this issue? And also the same product can be, for example, say cotton yarn that comes from the mills to the handloom weavers. You exempt that yarn for the handloom weavers, but you don't exempt that yarn for somebody else.
So under the current system, all those things will be, that's why we have a GST. We want to bring everyone into the net. One last question. Yeah, exactly. So remember that, the more you bring into the net, the fewer problems like this. But in principle, there will be some people who can still remain completely outside the net, and that's something that over time, what will happen is that as formalization happens, you will get fewer and fewer people. Remember, in this, the advantage of this is that if you are buying inputs, you have an incentive to start registering yourself in order to get input tax credits from a previous stage. So I think the incentives are all very good, unless of course you want to evade altogether. I think I will, just to clarify something. So if you remember in this second example, we spoke about goods being exempt, and despite being exempt, they carry these embedded taxes. I want to make a distinction between being exempt and being zero rated. There is something called goods being zero rated. In most advanced economies, in India, food is exempted. In those economies, food is zero rated. Similarly, in India and everywhere, exports are zero rated. So what's the difference between exempt and zero rated? Just go to this second column. So we said on the final product, there's a zero rate. Right? And it's exempt. And we saw what happened. If it's zero rated, what happens is that this is zero, but you also get input taxes on all the previous stages. So this becomes then minus 20, this becomes 0, and this becomes 0, and then the effective tax becomes 0. So that's the difference between, so what you want to do when you exempt a product, it still carries all the embedded taxes at previous stages. But if it's exports especially, because remember, when you sell something abroad, you don't want it to carry embedded taxes because that makes you uncompetitive vis-a-vis foreign goods. So that's the difference between being zero. So zero rated is you pay zero on the output, but you get back the input taxes on all previous stages. So zero rating is what truly gets the taxes on something to zero, whereas exemption doesn't get you to zero, gets you to a different rate, a lower rate, but not a zero rate. So I just thought I'd make this clear, just for the sake of completeness. Yeah.
Now it will be sold for 300 or 320?
300, exactly. That's the point. It will be sold for 300, exactly, because that's zero.
In India, we have only exports.
Yeah, virtually only exports are zero rated. There are no zero rating of products per se. So just to go through the quick benefits of this, I think it's going to reduce corruption and leakage for the reason that I just mentioned, because of the paper trail that will be created. I think we have to understand what it's doing in terms of simplification. And I want to take you to, this is the current structure of central taxes and state taxes. So you have a central excise tax number of rates 8, state taxes 3, sometimes more. In the case of services, services, you have a negative list and many rates. So essentially the current system is quite complicated, one. Second, also different states can have different taxes on the same product, and the center and the states also could have different taxes on the same product. So what the GST is going to be doing is going to be both simplifying. All these rates are going to be reduced. Now I'm going to tell you what the final structure of rates is, but there's also going to be uniformity between center and states and across states. So this one product, one tax all over India, and so that's going to be very different under a GST. Yeah.
What is this base percentage?
So under the current system, there's a standard rate and there's a lower rate. What is the share of the base between the two? The base, the taxable base. What percentage of the taxable base falls into? This is, by the way, in my revenue neutral report, which you can access and go through this in greater detail. Now, essentially, this is part of the simplification, especially with the state taxes. There are a number of taxes which are going to be absorbed in the GST. For example, Punjab has purchase taxes on agricultural products. Arathya taxes, all those should be subsumed under the GST. So,
in case of Punjab, will it be destination based, that is the consuming state, or Punjab government will get the revenue?
no, it'll all now everything consumer based, everything consumer based, and I'll tell you what, I'll come to that and what the consequences will be in a second. The other, now that simplification and bringing uniformity is a bit different from creating a common market by eliminating taxes on interstate trade. At the moment, there's something called a central sales tax, which is a tax that's levied when you sell from one state to the other. That, and similarly octroi and some other interstate taxes, will be eliminated, so you're going to get one common market. So one tax on one product, and also no barriers on taxes between states. Then there is going to be a benefit in terms of Make in India, because currently what happens is that supposing you exempt a good from taxes, the amount that's going to be levied on imports will be zero, because every domestic tax, as I showed you, it's on final consumption expenditure, including expenditure on imports. So supposing there's a car, a domestic car will face a tax of, let's say, 18%. The imported car will also face that 18% over and above the duty, because that's what equalizes the conditions of competition between the two. But if you have a zero tax, the import will face zero. But then, because of this cascading business, the domestic tax will bear a higher tax than the imported product. That's why it favors imports, and those kinds of anomalous situations will be eliminated. We've talked about cascading. I think that because now more and more things will come in, also the crediting between service inputs going into goods and goods inputs going into services, that will become much more seamless, and so we'll get more input tax credits, more tax credits for all purchases of capital goods as well, and so that should boost boost the base, boost investment, and hence medium-term growth. There are various estimates of what would be the impact of GST on long-run growth. I've not done any calculations myself. The IMF has done some calculations earlier. I think NCAR had done some calculations. You can check those up. I don't feel totally comfortable about these growth numbers, but you can check them up. Now I come to my last point, and then I'm going to answer the question that was raised. To me, and I've been attending many of these meetings of the GST Council, which has been set up after the constitutional amendment, I think that over and above all these benefits, which are tax-related benefits, the GST is actually a remarkable institutional development. It is a remarkable development in the governance of cooperative federalism in the following sense. Now, all tax decisions on indirect taxes, now the GST, will be taken together by the center and the states. So states lose some sovereignty, but gain some sovereignty, the center loses some sovereignty, the center gains some sovereignty, because everything is going to be done together. That's why we use the phrase shared sovereignty. But the question that was asked was, I mean, do the states lose some fiscal autonomy because now all these things, earlier they could decide it unilaterally, now you have to do it together? The answer to that is that under the GST, there are still a number of goods, especially two big ones, actually three I would say, petroleum, alcohol and electricity, that are still within the purview of the states. You don't lose control. In fact, if you put alcohol and petroleum, for every state it would be at least 50% of total revenues. So in that sense, I have no sympathy for someone saying states have lost all sovereignty, because now, however, if in future these things do come in, then of course I think that, in addition, of course, stamp duties are levied by the states still on their own, so they have that source of power as well. So yes, some amount of sovereignty has been given up, but about currently at least 50% of taxes still states can decide on their own. Now, what is the proposed structure of taxes? So what's been decided so far is that the GST is going to have 1, 2, 3, 4, 5, 6 rates, a 0, a 3% slab for gold, and the column there tells you how many lines. In all, in the case of goods, there's something like 11 or 12,000 lines. That gives you the allocation. Oh well, it's 1,100 lines maybe. It depends on which level you're measuring it. But as you can see that most of the lines are the 18%. Some lines are in 200. So between the 12, 18 and 28 you get the bulk of the lines. But in addition to that, there are going to be cesses on several categories of products: tobacco, aerated beverages, luxury cars. These are three, one or two more, but these are the three big commodities on which they're going to be cesses. So it depends on what degree. See, in the case of goods, you have what's called an HS classification. If you do it at the 8-digit level, you get a certain number of lines. If you do it at the 6-digit, you get fewer. I think I can check this for you. This is probably about 1,200 lines if you add it up, and maybe it's at HS 4-digit level, but it's about 1,200 lines in all. This is just goods. In addition, you have services. Services also are going to fall into these categories. But I want you to look at, and in a sense, this answers the question earlier as well. So there are going to be some goods that are completely outside the GST. Alcohol forever, because it's in the Constitutional Amendment Bill, it's not going to be a thing. Petroleum is going to be out for 5 years, and after that the GST Council can decide to bring it in. Electricity, healthcare, education, land and real estate are also outside the GST, although in all these cases, I think at any point the GST Council, even without a constitutional amendment bill, can decide or not whether to bring it in. So essentially what's happened now is that you've got true cooperative federalism on these matters. The GST Council can sit together and do whatever it wants in terms of changing rates, bringing goods in, taking them out, and so on.
So in case of alcohol, VAT will continue?
Continue. VAT will continue, and states, whatever they do on petroleum, will continue.
Is there any study wherein all these products which are out of GST,
yeah,
what is their contribution in GDP?
Yeah, there is, if you'll go to the revenue neutral report that I did, you will have calculations on that. I mean, it's quite substantial. Okay. Yeah, it's quite substantial. And yeah, question? The question was what percentage of the base is left out by those exemptions, and the answer is that it's quite substantial. The exact numbers are in the report that I did, the revenue neutral report given to the government. You can see, because by definition petroleum and alcohol are huge. Electricity is big, land and real estate potentially is also quite big.
Is that part of the reason why they were kept out of GST?
I think, there are different reasons for why different commodities were kept out of GST.
Education is what I'm interested in.
No, I'm more into. I'll tell you education. So the question is, why were some goods kept out of the GST? I think in the case of alcohol and land and real estate, it has a lot to do with politics. I think you bring it into the GST, it becomes cleaner and therefore more difficult to escape. So that's what I think. I think in the case of health and education, there is a sense that these are goods that are public goods and consumed by the poor, and therefore, although if you look at the numbers in the revenue neutral rate report, actually it's not the case. I think a bulk of this is consumed by the rich, if you look at the numbers. So it's not always done for the right reason.
In case of food grains, it would be exempt, I guess.
Okay, yeah, many food products are exempt. I think that, distinguish two things. One is that those taxes will have to go. Those taxes will have to go. You'll now only get, if it's exempted, it's exempted. And now let me just come to that will answer your question.
I have a small question.
Yeah.
Just a very small clarificatory question.
Yeah.
The number of product lines falling in each band is fixed. There is going to be no change.
Yesterday they just changed that actually. Yeah, exactly. See, remember, this is cooperative federalism. If you get together, you can change things. So.
It is not because you are teaching here, no?
No. Yeah, I wish that were true. I must say that while it was. I don't know whether I should say this or not, but it's really exciting to be part of this. But in this business, I think that between what you think is the best possible outcome and what actually happens, let's say there's a gap. Politics comes in, and but that's the way the world works. Now let me come to the Punjab question because it's related. So essentially, that the central government has guaranteed all state governments 14% growth in revenues for 5 years. So take the case of Punjab. What Punjab does, for example, is that it charges money. So supposing FCI goes and buys grain in Punjab, wheat or rice, it has to pay the MSP plus whatever taxes are levied, and Punjab gets to keep that money. It will now lose that because it's now going to be a seamless GST, but Punjab will be guaranteed, as will all states, that all the GST revenues that going forward, they will get at least 14% growth of revenues. Now, this is, I think, there was a big debate on how much the compensation should be. Under the old VAT, the compensation was only for 3 years. Now it's for 5 years. And now there's 14% growth. Now, the difference is, of course, that under the old VAT, the VAT was being implemented, as I just showed you, at a time when growth was very rapid. So, all this became, after 1 or 2 years, there was virtually very little compensation. But now, if growth is not going to be as strong, these things could become quite important. Now, compensation will be financed by these cesses. There are tobacco, luxury cars. You can go to the website of the Department of Revenue and see what these cesses are.
So when the compensation period will be over,
5 years.
These cesses will also be.
Very good question. What will happen to the cesses after the 5-year compensation period? And the answer is a very simple one. Whatever the GST Council decides. See, in principle, I think, but conceptually, the question is a very good one, because conceptually, if these are compensation cesses, then when the compensation goes, these should become part of the GST. Remember, the difference between a cess and a GST is that on the cess, is not vatable. You can't get input tax credits on this, but once they come into the GST, they could be. Actually, I take back what I just said a little bit, because in all these cesses, the way it's going to work is they will be, almost all these cesses will be at the 28%. And then the cess will be in addition to the 28% they're going to be in. So you will get input tax credits on them to the extent of 28%. But whether these cesses will disappear, which in principle they should, because they're called compensation cesses, will be determined by the GST Council. Now, You can think of many scenarios. You can think of a scenario where I think actually after a few years, 1-2 years, revenues should be buoyant enough that all this will become moot. There's another scenario which says, no, even after 5 years, Punjab, for example, will see such a big reduction that you may have to continue. But let's see how it pans out.
Just one thing, since GST is basically a destination tax, what was the thinking about putting 3% on gold?
Okay, so the gold was one of those battles I fought and lost, one of many battles I fought and lost. See, I think that in the case of gold, let me tell you, if you want all the gory detail on gold, essentially that until last budget, gold was taxed by the states at 1%, and there was no central tax on it at all. There was no excise. In the last budget, 1% tax was levied, and the gold lobby was up in arms. The government, to its great credit, resisted that, because the big difference between going to 0 and 1 is that once you go to 1, you have to keep records. At 0, you don't have to keep any records. They fought it tooth and nail, and they lost. And I think, so now we've gone from 1 + 1 to 1.5 + 1.5, 3. And there are two competing considerations that went into it. One is this case I made very strongly in my report, and many, Kerala and other states also said, if you look at the data of consumption on gold, I mean, it is amazing. If you look at the NSS data, about 80% of the expenditure on gold is by the top 10 or 20%. So it is a good that's consumed by the very rich. In fact, the NSS data, what I just said, probably significantly understates this, because the NSS by definition doesn't capture the very rich. So if you took that into account, it would probably be, the top, 5% are consuming maybe 90% of this, whatever. So, but that argued for higher rates. But then in the case of gold, the legitimate point was made that it's easily prone to evasion. That, if you start raising the tax too much, it will lead to evasion, and that's not very good. So finally a compromise was struck. In fact, on this GST, on this issue, this happened in the last meeting. States were divided, and then a compromise had to be struck, and that's how it came to 3%. Question, only question, no comment. So let. No. I think having heard you, I think it's going to be a comment. So. You see, I think that I don't want to get into the politics. There's some politics also going on, whatever, which I don't want to get involved in. But I think, remember, it is going to be a very new system. It's going to have, a really new IT backbone. I mean, the amount of, technological infrastructure that's going into this is just incredible and very, very impressive. It has to be done. There's going to be a GSTN. Some states are going to have their own systems. How are the two going to be coordinated? So I think there is some genuine anxiety about the early implementation. I think there will be some teething troubles. But after some point, all change is difficult. All change people resist. But I think after 3, 4, 5, 6 months, I think things should settle into a pattern. Yeah? Question, yeah.
So what about local bodies tax?
Local body, question is, what happens to local body taxes? They are not covered by this at all. Now, in the GST report, so now that we've settled on the 18 and 28% rate, how does it compare with other countries? It turns out, those two lines at the end, the yellow lines, these are the 18 and 28% rate. I think it's on the high side. If you compare it with other countries, these countries, for example, are not good comparisons, because these are European countries with large welfare states and have high VATs. But if you take those countries away and compare it with other emerging market countries, our tax is on the high side, 28% and 18%. But I think that's just a fact of life. It's a slightly unfortunate outcome, but we are where we are on that. I think, you can also do an impact on prices. We did this in the R&R committee report. You see, because what you have to see is that you have to see what the tax incidence is today, and then what it's going to be tomorrow. You do it in terms of the CPI is interesting, because if you look at that last column, the 47.1 plus 6.7% are actually outside, going to be exempt from GST. So when you do the before and after, it's pretty much the rest that's going to change. And what we find is that, these numbers are now going to be done because only now do we know what the exact structure of rates is going to be. I think that now more and more you will see studies on, doing proper before after calculations on this. But especially after what happened yesterday, I think the likelihood is that the incidence is going to come down, and so what I've been saying in public is that therefore any fears about inflation from this are probably exaggerated, because if you look at the actual incidence of taxes, especially after yesterday, they are going to come down. So a very good time to conclude. So I think it's a huge political and economic achievement, because the GST has been under discussion for 10, 15 years, and successive governments have had difficulty forging the political consensus amongst the states to get it. I think that the big benefits are the reduction in complexity, greater uniformity, a reduction in interstate taxes, more seamless flow of input tax credits. And even though there's going to be a reduction in incidence, I do think that the tax revenue collection will not suffer, at least not after a certain point in time, because of all that I said about the invoice mismatching, the compliance benefits, the self-policing, all that will happen. But I don't want to make this sound, totally rah-rah. The question that, sir, you asked is, I think, probably a very, very important question for the future. You see that both in terms of how much of the base has been left out and how much it still remains complex, 6 rates for goods and for services, and the cesses, which are, and actually if you look at the cesses, there are multiple cesses as well within tobacco, within luxury cars, some at 15, some at 5. So it is a somewhat complicated structure. So I think that the effort going forward has to be in the GST Council to try and expand the base as much as possible, to try and make it more simple and less complicated than it is today. Now, you can take 2 views on this. The one optimistic view would be, look, everything can be decided by the GST Council, and if they see that this is working well, taxes are buoyant, they could then choose to, and they say the policing benefits. For example, land and real estate, there's no reason why that shouldn't come down, and I made a strong pitch for that some time ago. I mean, if you really want to address corruption, land is a big source of corruption. I think that, so the positive view would be that, GST Council will see the benefits from the GST and over time will take decisions to improve it. The other view, of course, is that it is easier to do big things at the beginning, at what we call big constitutional moments, because over time, kind of bad habits might set in. People, they don't want to change, because any change, of course, especially in an upward direction, is very difficult. So we have to see how this process is going to pan out, and I think that over the next 4 or 5 years, in terms of, but coming back now to, how you would teach this, I think that, this is really a very interesting topic to teach your students at this stage. I think it's important to, bring the policy up to the forefront and use that actually to take take them through how this tax is going to work, what the benefits and costs are, maybe ask them to do a few simple exercises. And I think it would be really very interesting for students to really understand how the GST works. So I think we were running behind. I think that now we're on schedule. So I will allow 3 or 4 questions. But first, raise your hands, wait for the mic, please, Mike. But please, I insist only questions.
Sir, what is the rationale of this 14% growth guarantee?
What is the rationale for 14? I guess that, okay, there is a rationale. We worked out, what was the revenue growth in the last few years for these states. Under various assumptions, I worked it out. And then what did we do under the previous VAT? And essentially, I think we wanted to err on the side of generosity in order to reassure states that, to get political buy-in to this, you had to, Punjab, for example, would lose a lot of money. So we looked at past trends, looked at what we thought, how GDP would evolve over the next few years, because that's what's going to determine the tax base, made an assessment, and then to kind of give a little more to err on the side so that to reassure states that, under most states of the world, they should not lose relative to what they have today. So that was the calculation. Yeah, please, I want, especially those who haven't asked questions. Yeah, one question here.
Where this cess is levied? Is it levied on intermediate goods also?
No, the list of, so the question is that on which products are the cesses levied?
No, the question is that for just like for luxury cars.
Yeah.
It is,
no, it will be levied at final, always, yeah, exactly, final stage, yeah, exactly.
So, are we going to get input credit for the commodities which will be still under, or anything under VAT? Tax credit?
So I thought actually the question was, will you get tax credit for those commodities inside the GST?
Outside, yeah.
Yeah,
I mean,
the important question is what happens outside.
Yeah.
By definition, for example, petroleum, you will not get input tax credit. However, I think that's a very good question. I don't want to get too detailed, but in computing the rates, we have taken that into account.
Okay.
Yeah.
No.
Now, one last question.
Last question, sir.
Yeah.
Sir, how do you think reforms could not have, still today in our country, reforms could not make any consensus? And I think...
No, we've had consensus. We got a constitutional amendment bill passed. How can you say there's no consensus? This is a major political achievement.
Consensus is not emerging, sir.
The question is July 1, will you see the GST or not? And my money is on that happening on July 1. And the FM said so yesterday.
Slide number 88.
It was passed unanimous?
No.
majority.
No, it's no, in the vote on the constitutional amendment bill, I was there. The vote was 400 whatever to 0.
Unanimous.
It was unanimous.
One explanation on slide 88.
Slide 88, the question is?
The furthering, negative protection one. If there is no exemption for VAT and CVD and excise, then there is no negative protection. It is only when there is a CVD exemption, then there is a negative protection.
Yeah. See, if you charge excise, so if you don't charge excise and charge, let me put it this way. If you charge excise but don't charge CVD, by definition there's a, but the interesting case is that if you don't charge for both, there's still negative, and that's the example. Because essentially that, you saw that with exemption you get the embedded taxes in that. Okay, so we're on schedule. We're going to meet at 2:30, 2 o'clock. Oh, we're going to meet at 2 o'clock, and I will begin at 2 o'clock.